It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
We're going to be talking about, I think, rate hikes next year, unless, of course, there's some major financial catastrophe that takes all that off the table. But if the normal flow of the economic cycle continues to play out, I think we're shifting towards a situation where the current cash rate of 3.6% is not restrictive, is not tight for the whole economy, and that we may see some rate hikes in the second half of next year.
And that is Warren Hogan on the Real Estate Breakfast this morning. And welcome back to another episode of Mulling Over what is happening in the property market with our run-up to the Christmas break. The market is busy out there. Some would say red hot with FOMO back in time just for the new year. Not that you'll want to hear that if you're trying to get into the property market. It is a Wednesday, November the 12th. A radical proposal by Donald Trump to introduce 50-year home loans in the US. Now, that has drawn fierce backlash from housing experts worldwide, including in Australia. Critics are warning such ultra-long mortgages would trap buyers in debt for life, inflating repayments and delaying true ownership until they're in their 80s. Meanwhile, Trump claims that it would make homes more affordable. Experts say, however, it only masks the problem, offering lower monthly payments but costing families hundreds of thousands of dollars more in interest over a period of time, deepening, they say, the housing affordability crisis. Yes, madness on one side, but on the other side, would you be prepared to take a 50-year mortgage to get into the property market? Let us know by way of our voice message recorder. You'll find that in the show notes, or you can send us an email, myrealestatepodcast@gmail.com. Right, let's go to Sydney and catch up with economist Warren Hogan. Welcome back, Warren, to the Real Estate Breakfast. Got to pick it up from there. 50-year mortgages in the US, good or bad?
Yeah, good morning and thanks for having me back. Yeah, generally bad. When politicians start suggesting things like 50-year mortgages or intergenerational mortgages, it's actually a reflection of a problem in the economy and the market. We've seen it in Japan many years ago, where they had extraordinarily expensive housing. We've heard murmurs of it here in Australia at times, and this is just a reflection of it's a solution to a problem that has better solutions. Having mortgages that go for 50 years is just, as you said, just going to create a longer commitment. And of course, we're already seeing hints of it in the sense that as a 50-year-old in Australia, it's not too hard to get a 30-year mortgage, let alone a 30-year-old getting a 50-year one. So I think the real issue is that this is just another sort of marker that we've got some real underlying asset price or house price problems. This is not the solution.
Yeah, having a look in the US, Goldman Sachs has sounded the alarm over a global credit explosion, warning that private lending has surged past the $5 trillion mark, creating conditions ripe for large-scale defaults that could spark a broader financial shock. Meantime, in amongst that, the IMF's Global Financial Stability Report highlights mounting rollover risks, with massive volumes of real estate and sovereign bonds set to mature around now and into early next year. They say a potential flashpoint for global markets. And you've got The Guardian commentating, saying that the system is flashing early warning signs of crisis, urging that what investors don't know scares them the most. Now, they're saying that that is amid opaque financing structures. So what do you make of all of that? Because we should be paying attention in Australia and taking note.
Yeah, well, we should be. We should be paying attention to what happens in the big markets, particularly in the United States, because inevitably that'll have ramifications for us. And of course, we are seeing ASIC and other regulators getting increasingly focused on these, as you said, opaque financial structures that sit outside the regulated banking system. Although I should note that, here in Australia, our private credit markets are much smaller and less developed than those ones you see in the US and Europe. But look, the bottom line of this is that, there there is an element of all you have to fear is fear itself, i.e. the opaqueness, but there is also, I believe, some real signs of distress. We're seeing it here in Australia with individual assets, you might say, not looking great, and we've had that sort of published in various financial press all through this year. But it's really, I think, a reflection of this growth in financing going on outside of the banking system, private credit, heavily regulated banking system, and then, of course, a lot of high net worth and other investors looking for a better return. They seem to get through the big lift in interest rates that we saw coming out of the pandemic around the world. But liquidity's been readily available. And I think these stories that you just mentioned are highlighting that liquidity is starting to turn a corner and funding unsustainable financial structures, that is, funding commercial property that's either in development or is developed and not performing well, can only go on so long before someone has to take a hit. And it's whether it's how big that problem is. In this instance, you're referring to the US. So look, there is definitely a higher level of risk around because of this. Here in Australia, we've seen ASIC make some commentary, and I think it's definitely a risk factor as we head into 2026, because I think liquidity is going to start to tighten up, whether that's formally through the Reserve Bank or other central banks having to raise interest rates, or informally because of the demographic shifts we're seeing.
You mentioned commercial property because that's being talked about quite heavily in the US, and there is some chatter in Australia about commercial property. Boy, some of these organisations, they are spending large, and they've got these syndicates, haven't they? So you've got the mum and dads that are investing in commercial property. Is that an area of concern to you from an economist's point of view?
It is, yeah. I mean, I think in Australia, it's not as big and it's not as systemic as you would see in the US, given those numbers you're talking about. Our markets aren't quite as developed, but it is a concern. It's a concern from a investor confidence and a regulatory point of view. That is the potential for individual investors to do their dough, so to speak, on bad investments. But it's also a concern from a broader market point of view, in that there's a lot of funding structures that are under pressure and they'll need to be resolved. And, the sooner you do it and the sooner the hit is taken by those involved, the more we can move on and, make sure the good property developments are funded, et cetera, et cetera. So this is a real issue and it's coming to light now. In Australia, it's going to continue to be an issue, I think, at that individual investor level, whereas, as we've talked about in the US, it could be a macro issue. That is, we could see a wholesale increase in demand for funding from the banking system to cover these bad structures, and we're getting hints of that now.
Right, we should have a look at the RBA rate cuts. Off the table. This was very disappointing for mortgage holders. What's next when it comes to rate cuts next year on your radar?
Yeah, well, the RBA's had to sort of face up to the realities of stronger economic activity over the last 3 months, and of course that higher inflation figure we got for the September quarter. They've therefore sent a pretty strong signal that rate cuts are off the table for the time being, and could well be off the table full stop. My sense of it is the economy is performing a lot better than many thought it would. There is a genuine recovery happening in consumer spending, which of course drove the slowdown a few years ago. That's seeing business activity pick up, and then I think we're going to start to see business investment and business spending more generally pick up, in which case we're going to be talking about, I think, rate hikes next year, unless of course there's some major financial catastrophe that takes all that off the table. But if the normal flow of the economic cycle continues to play out, I think we're shifting towards a situation where the current cash rate of 3.6% is not restrictive, is not tight for the whole economy, and that we may see some rate hikes in the second half of next year.
What do you think in terms of what's going on across the ditch with New Zealand? Of course, their cash rate is lower, but the economy, they're really struggling to sort of get some traction going in NZ.
Yeah, well, it's a range of issues there. I mean, the big one's population, which is a long-standing sort of issue. And of course, they've gone through a significant sort of property cycle, plus some big shifts in the regulatory framework around that from the last government to this. I think New Zealand's actually quite well placed to recover. And if there is a major shock to the world economy, I think New Zealand's better placed than it normally would be because it's sort of cleaned up its financial act, so to speak. And that's had a big cost to pay in the last 18 months. But I think it's going to hold the New Zealand economy in good stead going over the next few years.
Next year, now... It's a big year next year because baby boomers are going to be turning 80. Now, I sort of joke around a little bit with that. It's quite a massive thing, isn't it?
It is. I think it's a major global turning point that we're going to experience because what we once thought of as, old age, which you could say for most parts of the world was 65, it's just simply not the case anymore. The massive shift in the capabilities and quality of life of people all around the world over the age of 65 really, I think, means that 80 is the new number where people shift from being economically active, which is either working or spending a lot, through to requiring a lot of support, which that first baby boomer turning 80 next year, I think is a major shift for the world starting. And it goes back to what we talked about in terms of the financial risks and the non-bank credit, private credit story is that, their savings are going to start to be drawn on. So liquidity starting to will start shifting the other way. So this is a major turning point and it'll be a catalyst, I think, for putting some real change into the world's economies. And we're already starting to see it, of course, and it's not something that just happens on the flick of a switch. But from next year onwards, the baby boomer generation is genuinely getting old. They have accounted for a massive amount of savings over the last 20 years, 30 years, and they're going to start to need that savings.
Well, whichever way you square it, I think we're in for a very interesting 2026. Warren, thank you for coming back on to the Real Estate Breakfast this morning and giving us your thoughts. Have a great run-up to Christmas. You getting a bit of a break?
I hope so. Certainly will over the Christmas New Year period, but no rest for the wicked. As you said, next year's shaping up as being economically critical, so I want to make sure I'm all ready to rock and roll come the end of our summer.
Let's fuel your passion for property together. Join us, along with our industry experts, to help inspire and inform your next real estate decision.
And this morning we're going to have a look at rental yields and what the capital city as well as the regional areas are doing. Really interesting. Northern Territory, they are a runaway train for capital cities. Just have a look at this. We've got grey in the Northern Territories, Bakewell, Driver, Milner, Rosebery, Coconut Grove, Stewart Park, Wilna, Darwin City. Then right at the very bottom, we've got Melbourne. So if you look at top to bottom, in grey at the top of the list, $475 asking rent. That's got a gross rental yield of 8.73. And then you go down to Melbourne, $650 a week, 7.65. And then if we take a look at the highest rental yields in the regional areas, what have we got? We've got Western Australia at the top there, Kambalda West, that with a 9.43% rental yield. That's returning $390 weekly. We've got Queensland's Sunset at 9.04% as a gross rental yield. Western Australia, Newman is in on the action, 8.93%, $650 weekly rent. Then we've got Queensland further down with Parkside and also Collinsville. They are hovering around the 8.8%. And WA right down the bottom. So they're at the top and the bottom. Still decent, 8.81%. And that weekly rental in Somerville, $735. So hopefully that will give you some perspective into rental yields, both capital and regional areas this morning.
We connect you to the best real estate information across Australia. The Real Estate Podcast.